This is the Tan Talk Radio Network.
The opinions, thoughts, and observations on the IRS Solution Attorney radio show are not legal advice. Facts and circumstances differ in every case. Do not take anything said on the show as legal or accounting advice. Always consult your lawyer or accountant before deciding how to handle any legal issue.
Welcome to the IRS Solution Attorney Show. If you have problems with the IRS, don't focus on the negative, focus on the solutions. With the IRS Solution Attorney, Darren T. Mish. For over 15 years, he's been helping taxpayers with IRS problems reclaim their lives and their financial stability. Now, here's your host of the IRS Solution Attorney Show, Darren T. Mish.
Welcome. This is your host, Darren T. Mish of the IRS Solution Attorney Show. I'm here again today with Katrina Maywell, my co-host.
Welcome.
We're actually live today. That doesn't always happen. So if you have questions you want to call in, number is 727-441-3000. That's 727-441-3000.
And just in case you're driving, 727-441-3000.
Or we could throw you a curveball. You could call toll free at 866-826-1340. 866-826-1340. So I thought we'd talk about some common questions today that people generally have. Prospects, clients have questions about IRS matters and owing the IRS and IRS problems in general. And thought we'd start off with that today.
Sounds good. FAQs are always good, right? So the ones you get every day that you could answer on a regular basis in your day-to-day operation.
So part of my mission is educating the public on what all this stuff means. You know, every industry has its own jargon, and mine is no different. And I actually have jargon upon jargon, right? Because you have the lawyer jargon, and then you have the tax jargon. So part of the goal is to, simplify this a little bit so that people understand what's going on. The first thing I wanted to kind of tackle was, what are levies? So we use that term quite a bit, and it gets confused with levies versus liens. So we're going to probably talk about both of those today. A levy is simply a seizure. It's not like an epileptic seizure. It's like a seizure or a taking where the IRS, the government, wants to seize, either your bank account or your wages. Another way to look at it is a wage garnishment. I think that's probably, don't you think a wage garnishment is probably the more typical term that a regular lay person would use?
I think so, because most people get what a wage garnishment is because they've probably experienced it from one form or another, whether it's a debunked credit card or child support or whatever other reason an employer would garnish wages, right?
Well, thank goodness my experience with garnishments are not on a personal level, but only on a professional level. I hope that not most people have.
But I'm saying like the general conversation as far as the lay person probably know what that is because either themselves or someone they know has experienced that for one reason or another.
I agree. So a levy is really just a seizure. It's when the IRS wants to take something from you, some money, because you haven't paid. And it's important to note that I have clients come in almost every day, virtually trembling. I had one yesterday. The gentleman was very upset, and he was afraid. He had stayed up like a couple nights waiting to get to his appointment with us. He couldn't sleep because he was convinced that they were going to immediately, levy all of his bank accounts and his paycheck, and he would be living under a bridge with his kids. And
so that meeting day with you probably couldn't come soon enough.
Yeah, it turned out pretty good for him. I hope he slept better last night because, he was pre-assessment, which meant there wasn't even legally a tax due yet. He was just kind of worrying in advance. And I think that's something that we have to make sure that people don't do.
What does that look like when you say pre-assessment? What would that letter, because it's usually a letter, right? What does that letter look like if you were to get it from the IRS? What would the header on that say?
Okay, so there's a letter. I don't know what the header says, but the identifying number is a CP2000, and really it says something like this. Well, we've taken a look at your tax return, and we've noticed that you've left out this big chunk of income, and we went ahead and computed the new tax with interest and penalties for you as a courtesy, and if you agree, do nothing. So that's kind of a challenging thing, right?
It's like that double negative, right? They're trying to prompt people to actually take action.
So in his case, he had forgotten to put down some proceeds from a 1099-K, which is a credit card kind of proceeds, 1099-K, from PayPal, actually. And
so is that income he received from PayPal that he didn't claim?
Well, we're going to call it revenue.
Okay.
We're going to call it revenue because income...
Well, it's additional money that came into him some way or another.
For sure. He was doing like a side business where he was buying used stuff and selling, used stuff on eBay and basically being paid via PayPal. And a number of years ago, maybe 5 or 10 years ago, you could probably get away with that because that internet income kind of stuff wasn't really tied into the IRS. But over the last, I'd say 5 years, that's really gotten tightened up. And so PayPal is really, we don't think about this, but PayPal is really just a bank, right?
Yeah.
It's just a bank that facilitates online commerce. So in his case, he's going to have to report that income, but, he has cost of goods sold. So what that means is he has the cost of what the merchandise he was selling that he gets to deduct. So he only has to pay tax on the difference, on the profit.
Right.
In a lot of these transactions, there was no profit at all. And so the IRS is proposing an additional assessment of like $11,500. But I think this gentleman's margin, his profit margin was only about 10%. So he's probably only going to have to pay tax on about $3,000 or $4,000 when it's all said and done. So hopefully,
And that's the amount he's paying taxes on. That's not even what he's paying.
right, that's not even the tax bill. That's just the amount that he's going to have to pay tax on. So I think that problem's really largely going to go away. But the letters that the IRS sends are intentionally scary, and it puts some people into orbit. So it's really good to just kind of relax. I mean, I told him, I want to put you at ease so you can sleep because you look like, not very good. And, but I want you to take it, I still want you to take action to cure the problem. So that's really what a levy is. A levy is just a seizure, and it's just when the IRS wants to take something.
So what about a lien? Like, what's a lien?
I think because those two words start with L's, they get used interchangeably a lot. A lien is basically a claim and public notice to the world that the taxpayer owes the money. So when a notice of federal tax lien gets filed, it's just notice, it's public notice that, there's a debt that's owed to the IRS. And it's kind of like a mechanic's lien on real property. So a mechanic's lien, I got to explain that, right? A mechanic's lien
Can jump in on that one if you wanted to.
A mechanic's lien, okay, go ahead, jump in.
So mechanic's lien from a real estate world is like if you have someone come do work on your property and you don't pay them, they can put a mechanic's lien on your home because, like if you think about it like this, if you take your car to a mechanic, they can keep your car and hold it hostage until you pay them. When it's a house, they can't exactly keep your house, but they will place a mechanic's lien, which is for work done on the property.
Right. So the notice of federal tax lien, once it gets filed in the county that the real estate is located in, that lien attaches to that real estate. Technically, it attaches to all of the taxpayer's property, wherever it might be, whether it's real estate.
Anything tangible, personal, or otherwise, right?
Yeah. So literally, this pen I'm holding in my hand, technically, if I had a tax lien on me, this pen would have a lien against it. Now,
brutal.
What does it do as a practical matter? What's the consequences of having a tax lien filed against you? Well, there's a few. First of all, it's going to hit your credit score, and it's probably going to knock the score down probably 50 to 75 points. Pretty good hit, typically.
If it's personally, because there's a difference between personal and corporate, right?
For sure. So obviously, if it's against the corporation and not against the particular shareholder or officer, then that's a different thing. But we're talking about, I want to talk about at least personal. For right now. You introduce the corporate stuff, and we start to spin out of control pretty fast.
But it could be
here.
one or the other, right? Like,
Sure, it could be, for sure. So the lien attaches to the real property, it attaches to the personal property, it impacts the credit score. It's going to prevent the closing of a house. I mean, it's going to prevent conveyance of real property, which means the sale or transfer of real property, because it's just going to stick in that closing. When the title work gets done, it's going to show up, and then they're either going to have to pay it or
so the lien's kind of like any lien, like whether it's a mortgage lien or any lien, it kind of stays stagnant on there until something's done.
Yeah, it's not necessarily, well, the reason that they file the lien, the IRS, is to protect their interest. Right. So
just like a mortgager, right? They file a mortgage lien to protect their interest.
Exactly. And in our state, in Florida, we're a race state as far as recording, and so it's if that lien is recorded before the next lien, then it takes priority based upon
that's the lien line. Whoever gets to the courthouse first.
Exactly. So not all states are like that, by the way.
So the lien, does that, like, if you, as far as the pecking order, would the lien usually come first and the levies next?
Not
like,
always.
What do they do when they have that lien?
Not always. I believe that the standard operating procedure is for the IRS to file that lien once the debt hits a threshold amount. It's usually $25,000 or above, I believe. They can file it if it's $10,000 or above, but you don't see that all that often. So a caveat to that is if you already had a lien filed and then you filed another tax return with, say, $3,000 due, they're very well going to probably file another lien for that $3,000 because you've already kind of reached whatever that threshold amount is.
Mm-hmm.
In the Fresh Start Initiative, which is something that was passed by the IRS in the last few years, there's actually kind of an exciting program where if the taxpayer owes $25,000 or less, enters into an installment agreement that's a direct debit installment agreement, meaning the payments are automatically withdrawn from some account.
Mm-hmm.
After they've made 3 payments, the IRS will actually withdraw the tax lien, which is really neat because it's better than a release. The withdrawal is kind of like it never was there. So
it disappear from credit too?
It disappears from the credit report as well on the withdrawal. So
is it filed in public records?
The credit?
No, the lien.
Oh, absolutely. It's filed in the county, in Florida at least. It's filed in the county clerk's office.
It's probably not going to go away from credit
Well-
unless you intentionally try to take that off.
Well, my understanding is the withdrawal is better than the release. The withdrawal is like, oops, versus the release is like it's satisfied.
Well, it's like anything else when it hits credit. Withdrawal means we made an error, we're going to take it off. Satisfied means it's there, but we're going to show a zero balance.
Okay, so there you go. So withdrawal, and a lot of our clients, we're trying to do withdrawals instead of releases.
Which is better because then you can get it removed from the credit.
Yeah, so whenever possible, we're trying to do that on these liens for sure.
So what about dissipated assets? What's a dissipated asset? I don't think I've ever even heard us talk about that term.
A dissipated asset is when, okay, it's going to take a little while.
Okay.
We're talking about
We got a little while, Darren. I think we've got, according to my calculations, maybe roughly a little less than 45 minutes.
Okay, so when a taxpayer files an offer in compromise is like it's a program that allows you to make a deal to settle for less with the IRS. Okay, it's based upon a fairly simple math equation. We've talked about this a number of times on the show. The math equation goes like this: monthly disposable income times 12 plus the assets equals the amount of the offer. So for illustrative purposes, let's say taxpayer had $100 a month in monthly disposable income.
That's what's left over.
What's left over after their allowable
bills.
expenses are taken out. Okay, and allowable is a pretty important word here. Allowable means, according to the IRS standards, what the taxpayer is allowed to spend money on for purposes of this calculation. Okay, so if the monthly disposable income was $100, 100 times 12 is $1,200, and let's assume for just a moment that there's no assets. Well, then the taxpayer can make an offer for $1,200. It doesn't matter so much how much they owe. It matters much more how much they can afford to pay. So if they owed $250,000, if we can successfully show that the monthly disposable income is $100, there's no assets, the offer's $1,200, that's going to go through 99 times out of 100. Okay. Now, a dissipated asset situation comes up in this kind of bizarre situation. I haven't seen it as often in the last few years as I used to see it. But what happens is the IRS has a look back period, kind of like on a bankruptcy, where they can look back up to 10 years.
Wow.
On a taxpayer's record, so to speak. And if they see any large asset that was dissipated when they had a tax debt or had reason to know they were going to have a tax debt, then the IRS is going to have.
So they're looking to see if they sold some stuff, if there's some big swings or amounts going through those bank statements, right?
So
they're looking at bank statements, I would presume.
So not always, but in the bankruptcy world, we would call that a fraudulent transfer. In the IRS world, you just call it a dissipated asset. So it's not so often with the bank statements, although sometimes. But what happens a lot is vehicle titles.
So look at VINs to see if you had anything in your name.
Somehow they have some way to tap into state databases so that they can run, I don't know how they do it. It's probably the name DOB and the social security number, and they can run these state databases. And I get questions all the time about, hey, whatever happened to that 1992 Nissan Pulsar? And typically what the answer from my clients are, well, it's out back, with weeds growing out of it.
You want it?
Yeah, you're right. And it's not worth anything.
Come get it. It might cost you more to tow it.
But occasionally, I've had clients who accidentally forgot to include boats that they sold, 3 years ago and things like that.
Well, if you haven't had it for 3 years, I can imagine why they wouldn't think about it.
Exactly. So I didn't mean to be flippant when I said accidentally forgot.
Well, I know how your personality is, so I just had to make a remark on that.
But sometimes people do forget about assets that they dissipated in the past. It doesn't seem like it's coming up as often, but that's what a dissipated asset is. It's something where you intentionally sold the asset so that you would not have the ability to pay your tax bill.
Or show an asset that could be used for that.
Right.
So amended taxes, I think most people know what amended tax return is, but how does it relate to what you do?
Well, an amended tax return is just simply a corrected tax return that can be filed for up to 3 years, sometimes only 2 years. But it's like a corrected tax return. It goes on Form 1040-X. And a lot of people think that the IRS has to accept that amended return. They don't
Really?
have to accept
I
the
didn't know
amended
that.
return.
So they can say no. We're just rejecting this.
Yeah, I have a couple right now we're working on where the issue is.
Like, what grounds do they have to actually reject a tax return? Just out of curiosity.
I'll tell you one. I'll tell you a couple we're working on right
I'm
now,
always
and we're
putting the
not
cart
going
before the horse.
We're not going to lose these. But when a taxpayer has a canceled debt, like they have a short sale on their house, for example, and the bank, let's say they owed $300,000 on the house, and the bank forecloses and they sell it for $250,000. Well, there's a deficiency of that $50,000, right? So technically, that deficiency, when that debt gets canceled,
when your bank writes it off.
yeah, when the bank writes it off, this is really bizarre. I don't know why Congress passed this law, but that $50,000 gets issued on a 1099-C, and then the taxpayer is supposed to pay tax on that $50,000 of debt that was, quote, canceled.
Like it's income.
Like income that they never got. So it makes no sense to me, but there's two really huge exceptions to this rule. And that is, number one, if they wiped out the debt in a bankruptcy, then it doesn't apply, right? That would make no sense. That would mean that bankruptcy just meant every bankruptcy generated a gigantic tax bill. So that's kind of makes sense that that's there. The second one is if the taxpayer was insolvent at the time of the cancellation of debt, then the debt has to be.
Which means you had a hardship, which a lot of people that have a short sale do.
Right. So I've seen very few people, have seen some, but I've seen very few people who lost a house when they were not insolvent. There are always the people who make a conscious decision to go ahead and, walk away from homes, usually investors where they have 8 or 10 or something.
They call those strategic defaults.
Right. They just walk away from those. And those people, that's their decision. And I don't fault them for that. But in these cases,
but you still have the money.
Right. You still have a cancellation issue potentially. And so right now I'm dealing with two where they were actually one of these cases, Bank of America simply canceled a second mortgage that was being paid on and everything for no apparent reason. They just canceled it. They wrote it off. It turns out my client was insolvent at the time anyway. So we filed, she didn't know, so she filed her own return.
They had some kind of thing a while back. It was something that happened with the bailout money that they wiped out some of these loans. Because we had that come up in a client that was doing a short sale that had a first and a second, and the second was Bank of America. And then when they found out that second lien was wiped out, like they just forgave it, satisfied it, that changed the picture of them being able to keep the house.
Fantastic. It's probably a great thing.
So it worked out for them, yeah.
So in this particular case, she filed her own return. She didn't know how to deal with the cancellation of debt. She sort of writes it up as it's going to be taxable income because that's what the software or whatever told her, So she comes to us and she wants to know how I can help her. I'm like, oh, well, we can just amend the return and we can, characterize that as the fact that you were insolvent and we can wipe that tax out. Well, the IRS has now returned rejected that amended return. And they're basically saying I don't have any appeal rights. But you remember, I always have appeal rights. So I'm still appealing it, and we're going to win that case because they're actually wrong.
Like, what grounds do they have to reject it? Like, what do they say? What do they mail out when they're rejecting it?
We said like an Alice in Wonderland rejection letter that said, we disagree. We're not really saying why. And you have no appeal rights. The only thing you can do is pay the tax, and then you can file a suit in district court. And it's like, wrong.
That's not how we're going to happen.
That's not how we're going to do it. But if you can imagine, if you were just Joe Schmo, regular taxpayer who doesn't know what's going on, and then you get this scary letter from the IRS that says you lose, what do you think most people do? They just kind of go, I guess I lose. I guess I better pay the piper. So,
yeah, most people would say, I'm not fighting with the IRS. I'm not going to do that.
Right. Well, when we fight with them, remember, we don't fight nasty. We fight.
Well, you know the rules. It's a difference when you fight and you know the rules, right? That's why you hire attorneys, because they know the rules.
And it's funny, in my personal life, I'm not like really a sore loser at all. But in my professional life, it's like, we're not losing that one. I'm not letting that little old lady, eat $30,000 in taxes. Not on my watch.
It's about the principle at that point.
Yeah, actually. And if I have to spend a few extra hours to win that case for her, absolutely, it's a done deal. That's what we're going to do.
So what about penalty abatement?
We always talk about that fancy word, right?
Penalty abatement. That's an IRS word.
Abatement. Actually, the IRS train wreck of the week in our last segment is going to be all about
penalty abatement. Sounds like a little trap, doesn't it? Like a little trap. Just going to get you in there.
I can kind of imagine like a raccoon trap.
Yeah, that's what I'm picturing in my head.
An abatement is just an elimination of penalties. So it can be it could be an abatement of tax too. But abatement just means a reduction or elimination. So penalty abatement, really what's working right now very well is first-time penalty abatement. In a nutshell, taxpayers are entitled to a first-time penalty abatement if during the prior 3 years they didn't have any penalties. So, I mean, this is a gold mine for lots of people. And you just have to keep that in mind. The other type of penalty abatement that we think about most often is based on what we call reasonable cause. So that sounds like a lawyer phrase.
What does that
right?
mean?
So
reasonable cause.
I swear we spent a whole year in law school talking about the word reasonable. What does reasonable actually mean? That's how the law professor used to say it. That's how it's like deeply ingrained in
And
my
then
psyche.
you have a whole room full of attorneys that can argue what reasonable means.
What is reasonable? And it's kind of like you know it when you see it, okay? But in this context, reasonable cause means a very darn good reason why you didn't file your taxes or you didn't pay your taxes on time.
Like what?
I would say
What's a good reason that you see?
death, fire, divorce, hurricane, flood, pestilence, things like that. Really.
Where your data is wiped out or you don't have access to it or you couldn't do it or...
And interestingly, I don't think I've ever seen a case where many years strung together qualified for reasonable cause. So what I mean is, I had a case one time
It's
where...
a temporary hiccup or something happened in a year or two.
Right. It's usually 1, 2, maybe 3 years. But after that, I mean, there isn't reasonable cause.
It's intentional after 3 years,
well,
right?
We're not going to call it intentional.
I'm
That
just
sounds
saying, it kind
hard.
of seems like it's a little intentional. I'm not the attorney here, remember?
We're
I
not
can
gonna-
say stuff like that.
We're not going to call it intentional. We're going to just say perhaps negligent, right? There could-
Definitely negligent.
You know, there's lots of people out there, I think, they're self-employed. They just don't know what to do in terms of filing their tax returns. And if they just had some more education and kind of made a decision to do it, then they would file their returns and they'd get caught up with the IRS. It's so scary. It's so anxiety-ridden for most people to kind of deal with the non-filing of taxes. I don't know. I don't want to call it intentional. It sounds like harsh, you know?
Well, I mean, it's overwhelming, I think, to some people because most people are not that C type of personality that loves the numbers and the Excel spreadsheet and all that stuff. So when you think about whatever happened to them, whether it was a fire or a flood or whatever, loss of data, who knows? I can see why that task would be overwhelming because I've been there.
And it's kind of like your kids, you know, when they have a project that's due in 30 days.
And they wait till the night before to do
They
it.
wait till day, 28 or something. And then on day 28, there's something happens. Then on day 29, something happens. And then on day 30, they want to go to the teacher. This was me when I was a kid, by the way. Go to the teacher.
Oh, I thought you were talking about my kids.
Go to the teacher and you're like, okay, here's what happened. First, the dog ate the homework, and then, the house burnt down, and then there was a flood, and then, that hurricane came through, and now, we have a snow warning. So, I can't get my homework done. Well, if taxpayers do that too, where it's like, well, in tax year, 2011, I had this happen, and 12 that happened, and 13 that happened, and 14 that happened. You start to string those stories together, and it doesn't work so well. So,
eventually, it's just a procrastination excuse, really.
And I'm the first one to say that, like, getting organized and being organized and getting the tax returns done is really not a lot of fun, but it's just something that has to be done. Just like you got to pay your mortgage or your rent.
Hire a bookkeeper for a few bucks. Just get it done, you know?
Yeah, for sure. And if you're a business and you're doing your own payroll, like through QuickBooks Payroll or something like that, by all means, you need to hire a payroll company. I mean, some of these business owners are tripping over pennies to save dollars or other way around.
Yeah, we know what you mean. We got it. So we are live in the studio today. We have to take a quick break because we're at the bottom of the hour, but 727-441-3000. Call in with your IRS questions and Mr. Darren Mish will answer them. 727-441-3000. We'll be back in a minute.
This is the Tan Talk Radio Network.
Curious what your Tampa home is worth? Here's an easy way to find out what homes like yours are selling for in today's market. Text the word value to 813-377-2775 for a free report on Tampa house prices. We'll send you a free report with up-to-the-minute statistics based on all homes for sale sold in your neighborhood over the last 6 months in all price ranges. To get your free report on Tampa Bay house prices, just call or text the word value to 813-377-2775.
Are you suffering from IRS problems? Do you owe back taxes you can't pay? Is your paycheck or bank account being levied? Or maybe you haven't filed tax returns in years and simply don't know what to do. This is Darren T. Mish to tell you that if you're tired of IRS problems hanging over your head and are ready for a fresh start, we may be able to help. Call the law offices of Darren T. Mish at 888-GET-MISH. 888-GET-MISH. I can help you file old tax returns, work to release tax liens or stop wage levies, even negotiate deals to pay off back taxes at a discount, sometimes for pennies on the dollar. Hey, let's face it, these days it's not hard to get into tax trouble. A divorce, failed business, health problems, you name it. The point is, IRS problems may be solved if you're willing to take the first step. Call for a free consultation at 888-GET-MISH. That's 888-438-6474. Or go to the web at getirshelp.com, because the one sure thing is, IRS problems don't solve themselves. So get MISH. 888-438-6474. Principal Office, Tampa.
Ask me about an inside secret to save several hundreds of dollars on your annual homeowner's insurance premium. Text the word WIND, W-I-N-D, to 813-377-2775. Again, 813-377-2775. Hi, I'm Katrina Madewell, host of Tampa Home Talk. I'm going to give you market-appropriate, timely information regarding homeownership matters, because we want to make your everyday life better. Wherever you are in life, it's our mission to bring you good advice so you can maintain good credit, live within your means, and build wealth. My team and I are passionate about it. Love where you live, or I'll fix it. Tampa Home Talk on WTAN every Thursday and Saturday at 5 p.m.
This is the Tan Talk Radio Network.
Welcome back. This is Darren Mish, the IRS Solution Attorney Show with Katrina Madewell.
I'm your co-host. Welcome back to the show. Just in case you missed it, we are answering some of those FAQs that you might have, or someone you might know that may have an issue or a little hiccup with the IRS, or have gotten a letter or a notice, and we can answer those for you on today's show because we are live in the studio. 727-441-3000. So if you're driving, pull over, and then you can put it in your phone and call us. 727-441-3000.
Is dialing the phone illegal now while
I
you're
don't
driving?
think so.
I don't think so.
I don't think it is.
But
Hopefully you're on Bluetooth, though, or something.
yeah, I have a
At
headset.
least. Yeah.
I have a headset I use when I drive.
So to continue with our FAQs, I know this one you probably see a lot because I'm sure a lot of people have seen this or heard it or know someone that's had it. When the IRS sends a notice to intent to levy.
Yeah, there's a couple different
That's
kinds
the pre-levy, right?
Yeah, there's a couple different notices that get issued to taxpayers that talk about notice of intent to levy. So I'm going to talk about the differences right now. There's one that's scary, but you shouldn't be afraid of it. Too afraid of it. And there's one that's scary, and you should be afraid of it.
Okay, do tell.
So the first one is IRS letter CP 504. Now you can find the IRS letter notices or the numbers in the upper right-hand corner of the notice. So if it says CP 504 in the upper right-hand corner, it's a notice of intent to levy, but if you read it closely, it says it's their notice that they intend to levy your state tax refund. So we're sitting here in Florida. We don't have a state income tax. There's several other states that don't as well. So if we're in Florida and you get a CP 504, whatever. It's not that important. It does tell you, it does actually increase the penalty rate. Okay, but if we're not going to pay because we're going to do an offer and compromise or something, it doesn't matter that much. But
so this is specifically to levy a tax refund?
A state tax refund.
Okay.
But also it's an indication of where you are in the collection cycle, right? So if you get a CP 504, your account is definitely in collections, and more will eventually happen. Okay, so that's what I use it for. When I'm looking at a client's file, I look at a CP 504. Okay, we haven't gotten to the point to an actual levy yet, but we're headed down that road. And we're going to have to do something, relatively soon. The second kind of notice of intent to levy is called a final notice of intent to levy. And just in the past couple of years, the IRS has really changed how this form looks. It used to be very distinctive. It used to look a lot different than the rest of the collection notices. It said final notice in real big letters on it, and it used to be a letter 1058. About 2 years ago, the IRS started using a letter LT11, and it looks just like every other collection letter. Literally, it looks exactly the same.
Why do you think they did that?
I think they did that because there's too many appeals being filed. Because you can file an appeal, which is called a request for a collection due process hearing, from an LT11 or a 1058, a final notice of intent to levy. You can actually appeal. You cannot file an appeal on a CP 504 because it's not ripe yet. It's not You haven't gotten
It's
far
just an
enough.
intent to do it,
Yeah,
right?
it's the intent to file or to levy the state tax refund. And like I said, in most states, it's just not a big deal. You know, even if you lived in some other state and, you know, you had $500 coming, I mean, it's not typically the end of the world. Like a real levy could be the end of the world almost, or at least it could feel like that, right?
Right.
So if they levy your bank account and they take all the money that you have in the bank, and you go to swipe the debit card down at the grocery store and it gets declined, and how are you going to pay for groceries? That qualifies as the end of the world just about, in my
Pretty
book.
much, yeah. Especially if you have little ones.
Yeah.
So what's the levy source information? Like, how do they get this to know that they're going to levy something?
Well, let's go back real quick to the LT11, the final notice of intent to levy. If
Okay.
you get one of those letters, you have the right to file a timely filed appeal within 30 days of the date on the letter. Interestingly, ignore the date you got the letter. It doesn't mean anything. What's important is the date on the letter, and they post date and predate letter stuff all the time.
So how do you verify what day that you actually got it?
Well, it doesn't
Is that
matter.
debatable?
Doesn't matter really what day you got it. It matters what date is on the letter. So I will often get IRS correspondence on behalf of clients that's dated in the future, which is sort of interesting, right?
So the postmark on the envelope does not matter.
It usually isn't even a postmark. But that's interesting that you said that. The final notice of intent to levy has to come certified mail. Cannot come regular mail. And so if you have a tax problem or you have a tax debt and you get that little orange thing that the post office leaves in your mailbox at home that says, hey, come by and pick this up or sign for it here or whatever, don't ignore that. This would be a very bad idea to ignore it. And routinely clients tell me, oh, I just ignored it. I blew it off. Well, just because you blow it off doesn't mean it isn't there, right? So you should definitely sign for it, and you should definitely, read it so you can see what's going on. You can file a timely filed appeal within 30 days off the final notice. That becomes a collection due process hearing. Due process is in the Constitution. It basically means that the government has to follow a certain set of procedural rules, so you have a opportunity to complain about some action that they're going to take. So this appeal gives you due process rights. If you blow that 30 days, it's kind of cool because there's a way to file a late appeal from day 31 to day 365.
Ooh, that's a lot of extra time.
So in the past, I've been doing this so long that you used to be able to file what's called an equivalent hearing. So it's a late filed appeal. We had an unlimited amount of time to file a late appeal, an equivalent hearing. So we used to routinely file equivalent hearing requests on cases where the final notice was issued like 8 years ago.
But now the IRS is like, we got to put a timeline on this.
And I think it was guys like me that actually causes the IRS to finally change the rules, because we find the chink in the armor, and we find the weakness, and then we
Push
just
that envelope.
exploit the heck out of the weakness, knowing that the government's eventually going to close it. But you got to get as many people through the chink in the wall as you can. So now,
Run while it's open, run!
and there's some other fine distinctions between the collection due process hearing and the equivalent hearing. The first and the most important is, if you want to appeal from the decision in a collection due process hearing, you can actually appeal to tax court. It doesn't happen that often, but you can appeal to tax court, and the burden of proof, or the burden of persuasion, is actually abuse of discretion. So in that appeal, you have to assert and prove that the IRS abused their discretion in your collection due process hearing. It's a pretty high hurdle. I've seen it, but
seems like
it doesn't
it.
happen that often. The other thing is that the collection due process stops the collection statute of limitations from running. So let's explain that real quick. There is a 10-year statute of limitations from the time a tax is billed or assessed against a taxpayer. The IRS only has 10 years to collect that tax, right? So if you file a collection due process hearing, a timely appeal, it actually tolls, which means stops the statute of limitations from running. All right. So that's usually not a good thing,
I was going to say, it kind of freezes time on you.
but it's kind of the trade-off, right? Because the collection due process hearing request gives you ironclad protection, at least with regard to those tax years, that the IRS cannot take any further collection action against you. So you get that, you get the collection hold, the IRS gets
More time.
the toll on this collection statute. Okay. On the equivalent hearing, it's a little bit different. What happens is that there's no tolling of the collection statute, but there's no technical collection hold that's mandatory. The IRS can decide to go ahead and give you a collection hold, and by the way, usually do, but they don't have to do it. But the statute continues to run. So what do we do in these cases where we have less than a year?
When you say give you a collection hold, you mean that 10 years, freezing that?
They'll usually just put a hold on all collection activity.
So they
they're
won't
not
pursue
going
it.
to levy you.
Okay.
They're not going to hassle you while the appeal is pending, but it's not stopping the collection
Gotcha.
collection statute from running. So in some cases, if the statute is short, so let's say there's a year left on the collection statute, I don't really want to stop that, right? I mean, that would be bad. If you got a year, we're just trying to run the clock out, right? We're just trying to keep the balls in the air so that we can, we'll get to the finish line, we're going to win, right? So sometimes we'll actually file a late appeal on purpose, knowing that the IRS is probably going to give us that collection hold, the informal hold where they're not going to hassle us. But the collection statute is going to continue to run. And some of these appeals take 3 months, 6 months, 7 months, 8 months.
So in the meantime, some of these clocks can be running out where they can actually even collect taxes.
Yeah, and I've never publicly said that
I
anywhere.
just said it, not you.
I've never publicly said that I file late appeals on purpose on occasion. But
sometimes
hey,
it happens anyway. Like stuff gets dropped in your lap late, I'm sure.
Well, the only time that would happen is if a client, brought it in on day 33 or something, and there's nothing I can do about it. But the other trade-off on the equivalent hearing is it doesn't stop the collection statute of limitations, but there's no appeal past that equivalent hearing. You can't go to tax court. You're just kind of done. So that's the big difference. Now, the question that you asked is, where does the IRS get the information from the levy sources?
Like, how do they know?
Well, I don't think I've ever read this anywhere, but just using common sense, I've come up with some theories. When you have a W-2 that's issued, where do you think it goes?
Well, they get a copy.
Yeah, they get a copy, so they know where you work, whether you file a return or not. If there's a W-2 there, they know, okay, that he works over
there at some point.
Yeah, he worked there, at least last year. And so they have that, information. If there's a 1099, and lots of people get one 1099, they just work for one sort of, I don't know,
contractor for a temporary time.
Or there's other people that have multiple 1099s, right? They might, they're really a contractor. And
if it's over whatever that amount is that you're paying, it's $600 or $700.
I think it's $600. Like so lots of people would have multiple 1099s. So they're going to get the information from the W-2s and 1099s, but also think about it, they're going to get it from the banks too. They're going to get, if you file a tax return and you have interest, then that's going to be reported on a 1099 also, INT, and then that's going to show up. So that's where they figure out, where you're banking. And if you've ever written them a check, there's a copy of it, so they know where you were banking, at least when that check was written. So I don't think it's all that high tech, honestly.
So they track whatever little thing. I mean, they have the routing number and stuff most of the time anyway on your taxes to.
If you're paying,
if you're getting money back,
or if you're getting money back, I guess. I don't think I've ever done that. I like the check, and it's got like a rainbow color on it.
I don't know how much they do that anymore. Do they?
I got a check this year.
Did you?
Yeah, for sure. So
I thought they'd like to wire everything now.
I'm sure they do like to do it, but
then they get your info.
So that's really where they get that information. If you're working, in the black market economy, you're working underground for cash, the IRS doesn't know where that money is coming from, and so it's not going to be easy to levy. I'm not encouraging anybody to work for cash in the underground economy. No, but that was just
my question, like, where is the source?
But yeah, if you're a guy that's mowing lawns door to door or something like that, and people are paying you cash, the IRS is not easily going to be able to levy that for sure.
So how long is the bank required to wait before the frozen account is actually released to the IRS?
So a lot of people use that, terminology of frozen bank account, and it's not. I guess it's only frozen for 1 day. Okay?
It's still frozen. Like, you can't get to what's in there when you want it. That's a pretty helpless feeling.
Well, on levy day, you're right. I guess it's frozen on the day that the levy is processed by the bank. So here's how it works is...
It's enough to scare people to not want to put any more money in the bank, I'm sure.
Yeah, that's for sure. So the bank levy is served on the bank of the taxpayer, and then the bank has to hold that money for 21 days. So that's to allow the taxpayer to have due process, to communicate with the IRS, try to get the IRS to release or issue a levy release to the bank so that the bank can release the funds back to the taxpayer. But the bank account is not frozen forevermore. It's only frozen on the day that the account, that the levy is received. So on day 2, you can go put some more money in there and you can continue to use your bank account. The bank levy is not continuous.
How often can they do that, though? Like, can they do it again? Like, do you see that?
Well, the Internal Revenue Manual says that they're not supposed to do, consecutive bank levies. And it also says they're not supposed to be punitive in nature, right? We used that word the other day.
Yeah, but what does that mean? That's an attorney word.
Punitive means they should not be punishing the taxpayer. It shouldn't, none of this collection action is supposed to be about punishment anymore after the reforms that passed in 1998. It's all supposed to be about collecting the money. So I have seen revenue officers who are IRS employees who are like the field level people who go collect the money. I've seen a few over my career act in punitive ways where it really had become personal, but it's really not all that typical. So a bank levy is supposed to be kind of isolated. The most frequently I've ever seen it is every month, and I think that was punitive. I think that revenue
And then
officer...
that could be, you could almost, not really retaliate's the wrong word, but you could appeal that in some way, right? Or another,
Yeah, you would speak to management at that point, and you could probably get them to stop doing that because it's not reasonable, okay?
Right.
And really the point of the bank levy is to collect some money for sure, but it's also to get the taxpayers' attention so that you pay attention and you start to take some steps to deal with the situation.
What kind of steps do you take to actually get that levy removed? Because let's say if someone had 10, 15, 20 grand, maybe more in their account at that time, they levied it and they've either, do they freeze it or swoop it or whatever they're doing on the day of that levy?
A lot of times you can't get the levy released, and I'll tell you why. One of the requirements to getting a release of a levy typically is you have to have all your missing returns done. So let's say you're a non-filer. Like I have lots of people that are non-filers, haven't filed in 10, 20, 30 years, right? So the general rule is they have to file the last 6 tax years' returns. But let's say they have 6 years of returns to do, and they just took the 20 grand that you were talking about in the bank account.
Right.
Now, number one, they probably don't have any records. And number two, now they don't have any money to hire any representation to try to help them to do that. And I would say your typical person on the street is incapable of preparing and filing 6 years worth of tax returns with zero resources.
Absolutely.
I mean, they're not going to have the best records and whatnot, and the paperwork burden for a self-employed person becomes pretty burdensome in 1 year. Can you imagine the burden of trying to do 6 years?
So you're saying most of the time you cannot get that release? They're just going to swoop it and keep the money?
A lot of times we can't get it released. If we can show that it's truly an economic hardship, that they're going to, not have a place to live, they're not going to be able to afford to buy food and medicine and stuff, we can often, I would say even typically get a partial release. Mm-hmm. But many, many, many bank levies are just really small amounts of money, right? So unless they hit you, for the average working person, unless they hit you on payday or within a couple days after payday, there's probably not all that much money in your checking account.
Right, but that could be your mortgage or whatever that's getting ready to draft.
Could be, for sure. So bank levies are really problematic. And what I would say is...
Yeah, because you could have written a check to your bank to write your mortgage, and then if it bounces, that's a whole snowball effect of problems.
Right. So what I would say is don't wait until you get a bank levy to try to deal with your problem with the IRS, because what happens is you end up in a situation where you have absolutely zero leverage, and all I can do for you is call and beg somebody to do the nice thing.
Depends on who you get on what day, right?
And
But if you have a good explanation, do you find that sometimes they cooperate?
Sometimes. It's especially if it's only a year or two, and you have a pretty good reason why that happened, that you might be able to get a partial release of the bank levy, or you might get an entirely a whole release of the bank levy. It's kind of dependent upon the facts and circumstances, but it reminds me of that old cartoon where the guy wanted to pay for the cheeseburger next Thursday. Don't wait until you're absolutely flat broke and then go look for help, because it's even harder to get it.
Yeah.
You have to have somebody who trusts you that you're going to pay when you can, and there's not a lot of people out there that are going to want to do that for the dozens of people or whatever.
What about that scenario that you just gave where someone has not paid their tax returns in, I think I heard you say 30 years a minute ago. What does somebody like that do if they have not literally filed a return and they don't even know how many years? Where the heck does somebody like that start?
Well, where
do you start?
You're going to have to call probably somebody like me, so that we can get a power of attorney, so that we can communicate with the IRS on your behalf, so we can get some records from the government. Because one of the things we can do is we can get the records, usually going back about 10 years, of all the wage and income that was happening in that taxpayer's life. Now, not the cash, okay? The cash, if you were working largely cash, there's not going to be any records there. But if you had received W-2s or 1099s or 1098s, those kinds of things, those records are going to be at the IRS. So that can be the starting point of preparing returns. Right? So your average person that comes to see me with these kinds of problems, literally almost 100% of the time, there's a fire, flood, hurricane story. You know? And I'm not denigrating anybody. There's just some reason why this kind of fell off the radar and just didn't get done.
So how far back do they actually have to file? Because I know you said they look back 10 years, but...
There's a policy at the IRS that says that you only have to go back 6 years. So that's really good news.
So anything before that, really, they just kind of get a clean slate. They just have to file the prior 6 years.
Yeah, not to encourage anybody to do
No,
this.
but I'm
you
just
kinda
saying,
get
if
away with
someone's
it.
listening and maybe they haven't filed in 20 years and they want to file.
Yeah, it's super common, and it's super common for reps to give bad advice and say, well, you have to file all of your tax returns. No, they don't. They only have to file the past 6 years.
When does that actually start? So, like, for example, we're in November now. Do they go by like the April deadline? I'm just curious. Like, what if someone is listening to the show and they're going, wow, that's me. I haven't filed my returns in 20 years. It's really been bothering me for years and years and years. I can't sleep. So I'm going to start seeing where I can get help to file the last 6 years back. But if you're getting really close to where they're wipe out a year, when's a good time to do that?
Well, it's a good question because here we are in the fall.
It's a legitimate question.
Right? And so my interpretation of the law or the rule or the policy is that for right now, you would have to go back to 2009, right? So we're in 2015 right now. So you'd have to fill out 2009, 2010, 2011, 2012, 2013, 2014. That would be your last 6 years. But in my opinion, as soon as we hit January 1st, baby, 2009's off the table because now you
That tax year's
theoretically
over.
can file 15, right? Because the tax
Gotcha.
year's over.
Yep.
And for some people, this could be, without going into too much detail, that could be a
Right.
real, benefit, right?
I mean, if it were me, I would want to try to start somewhere. I mean, because I'm sure there's people that haven't filed for a long time.
And I see on a pretty regular basis, I see, taxpayers who use different reps and their reps had them file the last 12 years or whatever. And, make no mistake, if you file a return that's older than 6 years and there's a tax due on there and it can be assessed, the IRS is going to assess it. You can't unring that bell. That
Right.
bell is done wrong at that point. So,
So
you
as
don't
soon
wanna
as you
make that
contact them,
mistake.
it's going to get moving.
Right.
Basically.
And there are some rare occasions why you might want to go back beyond 6 years that are kind of beyond the scope of what we're talking about.
Right.
But remember, if the IRS has prepared a return for you in the past, which is called a substitute for return, then you always have a right to file an original return that substantially changes that return. So that's
Right.
often a good idea, but not always mandatory.
So how does somebody like that find out? They have to go through someone like you, and then you file that authorization to talk to them to see if they filed anything?
Well, frankly, they can call the IRS on their own and ask for this information. They certainly can. They can call on their own.
But that's probably going to spark some collection, wouldn't you think?
It can, for sure, it can. But
I mean, if it's been dormant and there's been no activity for who knows how many years.
that's one of the nice things I think about having a rep is we very discreetly file a power of attorney, and the machine just sort of picks it up, puts it on the file, and it does. I've never seen a direct correlation between the filing of a power of attorney and the institution of immediate collection action.
That's kind of nice.
I've seen powers of attorney sit there for a year and a half, 2 years on people that owe $1 million and nothing ever happens. So I don't think there's a correlation between the filing of a power of attorney and collection action. And I think it would be a bit of a scandal if there was, right? I mean, if taxpayers are like trying to do the right
Yeah.
thing, hiring somebody to help them, hiring representation, and then the IRS decides they're going to clamp down only on people who have representation, there'd be hell to pay.
Yeah, actually, the attorneys would retaliate on that in a minute, I'm sure.
there'd be
That's the
hell to
last
pay.
person you want to pick a fight with. Is like the big dog in the room,
I
right?
never really thought about that, but there
I mean,
definitely would be hell to pay,
yeah.
and we'd be screaming, and we'd all be in Congress, testifying. About,
Yeah, they don't want that.
So that's probably not going to happen. So taxpayer can call the IRS. It can get these same transcripts that I can get, but then it comes into
They're like to stir the pot.
it comes into an experience thing too, right? I mean, I've handled thousands of cases.
Well, you
so-
kick the hornet's nest without a beekeeper suit on, So what about the person that has actually paid a tax bill late, and then the IRS sends this letter going, "You're late. We're going to assess you, all these penalties and interest and just all that snowball of stuff." So they filed it, they did it, it just got there late. What can they do about that? Anything?
Well, if you can prove it wasn't late, then that's the best of all worlds, right? So if you have an
So how are you
electronic
going to prove it's electronic?
If you had an electronic filing receipt, and you
What
could
if you
prove
mailed it?
If you mailed it, if you sent it certified mail, I've told this story before. I'll tell it again real quickly. One time I filed my return with paper, and I filed it certified mail, and I filed it on like April 14th. So it got to the IRS sometime like say April 20th or something like that. I get this love letter from them that says, "Hey, congratulations, you filed a return late. You owe us $500." So I don't even know why I did this because I know better. I called them up and I said, "Hey, what's up with that? I filed this thing on the 14th. It was timely filed, and you're dinging me for $500." And the lady was really, really nasty. She says, "Well, The only way that you can prove it is if you filed it certified mail and you can show us the receipt. I said, well, as a matter of fact, where do you want me to fax that? So
is this like where someone keeps a copy of the front of the
that little
envelope?
green slip, that little green slip has, when you go to the post office, they usually round stamp it with
Right.
like, it's an old fashioned like cancellation, and they also run it through the computer. And nowadays we have
So you can
tracking and
copy that
stuff.
or take a picture of it.
Yeah, you can copy it or take a picture of it or whatever and send it to the IRS.
With smartphones, that's easy.
And that saved me $500. So the way I look at it, that saved me 100 years of certified mailings on my tax return. So that's one way. The other way is from the first time penalty abatement that we talked about. So if this is an isolated thing, you filed your tax return late, and now you have a big penalty because you filed it late, but in the prior 3 years you didn't owe them any penalties. It was all, you were a good boy or girl.
Right.
Then you're just going to have to call them and ask them to abate the penalties on the late filing. It's going to go pretty smoothly.
Gotcha.
So, or if you had a really good reasonable cause, sometimes there's fires, in different parts of the country that delay filing, or hurricanes and that kind of thing. And those are often geographical, right? So
Gotcha.
if you're in
Everybody
a
in
flood
that
area,
region.
yeah, you get a little extra time.
So
like Katrina, I think they got like Hurricane Katrina, I think they
Yeah.
got like an extra year or something.
Not me specifically, but we
Yeah,
do
well,
a little damage.
You are a hurricane on occasion.
So that's about that time. We're a little late.
So I've got like 2 or 3 minutes to talk about the IRS train wreck of the week.
We got to get it in there.
So this was a really cool one that happened this week. Actually, I guess it was late last week. I had a client that was a dentist, and he got a tax bill from the IRS for $150,799.90. I mean, how's that for being exact, right? And I can't go too much into the details, but I knew that I could demonstrate categorically to the IRS that he did not owe this money at all. And so for a very reasonable fee, I got involved, and I actually complained to the taxpayer advocate. We've really never talked about the taxpayer advocate
No,
on
we
the
haven't.
show before.
We'll have to add that on another show.
The taxpayer advocate is an independent branch of the IRS, whatever that means. But they're an independent branch of the IRS that is there to help and assist taxpayers who have problems, bureaucratic snarls, that kind of thing. When I say problems, I don't mean like problems like I handle. Just really obvious things
Something
that
internal.
the bureaucracy has caused, right? I mean, that's how I use them at least. And my philosophy on using the taxpayer advocate is if I can explain it so simply and obviously that I win, that my child can understand, then that's the way you fill out the Form 911, the 911 form that you file to use the taxpayer advocate. Now, the people at taxpayer advocate are really nice. They're very professional. They follow up when they say they're going to do. They generally do what they're going to say. They say they're going to do.
That's
And
nice.
so, yeah, I mean, it's kind of rare in the government, actually. And so I employed the assistance of the taxpayer advocate in this particular case. I very simply explained why we were right in this instance. And within about, 45 days, 60 days, the IRS agreed, and they wiped out over $150,000 from this particular client's tax bill. So he was pretty stoked, actually. He was really, really happy.
I guess so.
And I was really happy, too, because whenever you stick your neck out professionally like that, where you say, listen, we can take care of this, it's always a little bit scary, but, you got to go and do the hard stuff if you want the accolades.
Absolutely. We got some questions on Twitter, and it's a little late to answer them, but feel free to hit us up at Darren_Mish. Again, on Twitter, that's at Darren_Mish. We promise we'll get back to you, and we will answer them next week.
Don't
That's
forget
it.
to visit the website at getirshelp.com. We're out.
Yeah, that was your job. Bye.
WTAN, Clearwater, Tampa Bay. WDCF, Dade City, Tampa Bay. WZHR, Zephyr Hills, Tampa Bay. Listen.
Was it a bomb? Guantanamo.